Hey, good morning. It's Friday, December 18th. Happy birthday to me. And it is time to look at the market. I want to explain what happened yesterday and the day before with the E-mini S&P 500, my analysis of what happened. Obviously, my analysis can be wrong. It's just the way I'm thinking what happened. This right here is the Fed's announcement of the rate hike. And this is what happened the day after when the market opened. This would have happened at the rate hike announcement, except my belief is the Fed came in with its circuit breaker on the previous open that morning of the announcement. Do you see how it hit that level? That's your circuit breaker. And they immediately, it immediately shot up because the initial knee-jerk response was to shoot up and then down, and the market was going to continue pile driving down. The algos had already been set up. Came down and hit this open and then immediately came back up. But they did not pile drive it up like Draghi did with the euro with his shock and awe, where he drove hedge funds out of business that day. There were billions of dollars lost in the euro that the other week, a month ago. They took their cue from that lesson and they gently supported this market up, which I thought was excellently done. I've been very impressed with the Federal Reserve, the United States Federal Reserve. They have kept our country afloat. They've kept the whole global economy going. I'm just so impressed with what they've done and how they've been able to do this. So they get an extreme amount of respect from me. So here is the overnight from the initial Globex, and then the London session comes, and the Globex pushes this back up higher above the previous high, but then the market starts floating back down until the open, where an open drive took it all the way down. And that was the correct response to the interest rate hike, because when you have higher interest rates, the corporations are going to have less money because they're going to be paying back their loans. So what has happened is we sold off, and then we came back into the previous close, touched it, and now the algos are coming back down. So we have not even retraced, people. This market is on a downtrend. So if I do the previous, where's my previous? Hang on. Let me get my indicators off my chart so I can see what I'm looking at. Okay, there it is. Couldn't see that line. So if I take my previous high, previous day high, with my previous day low, you see that the Globex bounced right on that 23.6 level, came back, tagged the previous close, and is bouncing back down. So we're in a range between the 23.6 and the previous close. So this is extremely technical trading now. We can tell that the Fed is not in this market because the algos are trading between these levels. When you see a touch on a level and then a retracement, that means some intervention came in or algos kicked in. Here was the previous open, pulled up, and before it went through it, settled, and then ran some stops, and we've been trading below the close, and we just hit the close again and have pulled back down. So this market has not even attempted to retrace back up in here. at this point. So now that we've got our downtrend going with our slope on our 30-minute chart, that's what I like to trade, the slope of the 30-minute chart, so that I know that, you know, yes, I'm not hitting the corners on a 5-minute chart, but I'm getting, once this 30-minute trend comes in, I'm getting a very high probability trade. And I make sure I look to see if it's matching my direction guide, and it is. Prior close, current open, and it's matching my higher time frame trend, which it is. So I can open my lower time frame chart, which does show me the corners, and I can start trading at a location. You see how this, I would not put the trade in here because we're at the bottom of the deviation band. I would wait for a bounce. I'm going to wait for a retracement, and then as soon as I get a candle change, then I would put an order in. So I would make sure that my 30-minute slope was going in the direction I want it to be. But this is a range, okay? Anytime you get a rectangle, you're not trending, you're ranging. So you would have to trust that this time it's going to break through the bottom of that range versus just an up and down. So you would trust your direction guide system to continue going back down. Should this keep going up, it's going to go back into the value. It'll come back up to the top of the range and potentially break back into the value. But if it does continue down the red slope on the 30-minute, then take the trade back down, breaking that range lower. So that's trading. You have to decide, am I in a trend or not? Right now you're not. You're in a range. So the rules are a little bit different. Here we are going up on my shorter time frame. So it's not matching my signals, so I'm not really looking for a trade right now. But that's all there is really to it. So I'm going to be looking for shorts unless I start seeing some mixed market. Move this right. Oops. There we go. And unless we see some mixed markets, I want to find a market that's moving directionally on the higher time frame trend. So I've got the E-mini or crude, and they're both going lower on the higher time frame trend, so I should only be looking for shorts. The NQ just went short too. So I use my 30-minute slope, I use my direction guide solver, and I have a base solver for my short-term corner trading where I can nail those corners pretty good. I can even get them tighter than this. I just want my separation between the inflection to make sure that the market has a chance to turn around or continue. And once you get in a trade, if you're going short and you have your support resistance or resistance support, your candle change, your inflection, you get back in, you put your pivot stop behind that pivot, and then you can trail it down until you get taken out. Not all trades will work out. This got a signal to continue the trend, but it went up to the mean. Trading is not a game of perfect, and you have to know your location in the market. Taking a trade inside a standard deviation, these lower standard deviations can be very high risk, not as high of a probability trade as launching one off of a upper deviation band. So I can go over the mechanics of how I use these levels to base my trades. When you're in a short, anytime you can get a trade off of an upper standard deviation 1, that's an excellent trade location. That's about as excellent as you can get. You can take one off here, and you can take your second one off here. Okay. So right now we're ranging, we're not trend trading. So we'll have to keep our eye on what's happening to see if we get an inflection to come back down and challenge this 23.6. And if it does, there are some levels down here that you can trade to. Here is the 61.8. Here is a previous close. Here's the 127.2. And if I put my market profile indicator back on here, I can have some additional levels to trade to down there. Here are some levels: a previous point of control, a previous value high, a previous value low. So all these levels, the algos would be tied to. And there's not really anything immediately left to the chart. So we might, if we clear these levels, a good possibility is that it would reach one of these two levels as a target, depending upon how much volume comes into the market should we get another thrust down. Another way to measure this is with the measured move. $59 points. So you could theoretically be expecting another 59-point run. So let's see. I can't get the ruler to work. That's 80. And that's 64.25. So I would say that this would be the lowest target to trade to from a measured move standpoint from the previous swing. So with that said, that's pretty much simplicity. You look for levels using Fibonacci value areas and your previous open close high low, and that's really all you need. Okay, standard deviation for VWAP, value areas for market profile. The point of control and the VWAP are different, and the algos are tied to both levels. It just depends on which level is there in front of the algo that it would trade to, obviously. The standard deviation 1 and 2, the upper 1 and 2, are different than value area high and low. And again, it just depends on the level and where it is for the algos to tie itself to it and trade to it. So once you get these levels down and understand how to use them in your trading and your short-term trading, you can come up with a trade plan, and then either, depending upon if the market's ranging or trading, trend trading, put a plan of attack together to capitalize on whether to enter value back to the other side or not. So this is Julie, J Auto Trading Strategies. If you'd like more information on how to put Bloodhound together on your chart so that you can use it in a structured way to trade, let me know. I'll be glad to help you set your charts up. Thank you so much. Y'all have a great holiday if I don't see you. I'm going to be going on vacation after today, so I won't be back until the first of the year for my recordings. I might be putting some things up on the website, but as far as instructional videos, but I won't be doing my market research. Thank you so much.